You know, if you think about every decade, the 70s were the decade of inflation. The 80s was a decade of kind of boom-bust, huge swings in dollar volatility. The 90s was equitization, the dot-com bubble. The aughts was the mortgage bubble and the great financial crisis. The teens were the peak of globalization and probably the peak of central bank experimentation with monetary policy, right? The 20s, I'm afraid, are going to be that period where we really focus on debt dynamics country by country, fiscal deficits, and the need to run certainly fiscal policy in a way that gives people confidence in the long-run value of the currency. And the problem that we've had really for the last 12 years is that we've done this massive experimentation with monetary policy where we suppressed yields, and we did this massive experimentation on the fiscal side during the pandemic. And so my guess is the 20s are going to be just the opposite of both. We're already seeing that right now from the central bank. Whoever is the president in 24 is going to be dealing with debt dynamics that are so dire. And so
so dire that this is the 1970s?
No, so dire that we're going to have fiscal retrenchment. And that fiscal retrenchment means that if we don't have fiscal retrenchment, that everything that we spent, if you think about the teens, which was all about suppressing yields, right? Mm-hmm. I think the 20s will be just the opposite. I mean, higher term premiums in bond markets, higher term premiums in stock markets. It'll be just the opposite of what we experienced the last decade. So in a time when there's too much money, which is why we have inflation, and too much fiscal spending, something like crypto, specifically Bitcoin and Ethereum, where there's a finite amount of that will have value at some point, someday. I don't know when that will be, but it will have value. That scarcity.
And the value at a much higher number than where we are today.
Oh, I think so, yeah.
Like?
I would think, so we're probably getting ready to go through the recession playbook, more likely than not. Sometime, I don't know whether it started now or whether it started 2 months ago. You always find out, and you're always surprised about when recession officially starts. But I'm assuming we're going to go into one. There's a specific playbook around that. And
what is that playbook?
Well, so that playbook is most recessions last about 300 days from the commencement of it. The stock market's down, say, 10%. The first thing that will happen will be short rates will stop going up and will start going down before the stock market actually bottoms. So that's why you could argue that two-year rates here may have some value or somewhere through here. And term premium gets put back into a variety of assets, into bond markets, into stock markets, and that's obviously what's happening. So you're seeing multiples compress in the stock market, as they should, and you're starting to see bond markets sell off because, again, term premiums being put back into them. So I would say when we get into that recession, there will be a point when the Fed stops hiking. There will be a point when it starts to either slow down or even at some point it'll reverse those cuts. And when that happens, you'll probably have a massive rally in a variety of beaten down inflation trades, including crypto.
I want to bring Becky into the conversation because she's got a question, but when do you expect that to happen?
Well, look, we've got rates at unemployment rates at 3.6%, I believe. It's very possible we haven't even started yet. It's very possible that when the NBR goes back and says, here's when the recession officially started, that it'll be somewhere within a month or two of now. Maybe, I doubt, again, with the unemployment rate so low that they would date it earlier than this. They look at 6 or 7 different measures, and you're always surprised ex post when they do.